Hello everyone and welcome to an Onchain update for the 23rd of July. I don't know if you've seen anything that's going on Twitter. It pains me to no end, to no unbelievable end, to have to cover once again why the stock-to-flow model is just absolute garbage. But here we are. This is 2023. We are still debating this stupid model. What I want to do is just provide some context because it's good to get your thoughts out, and just kind of explore these ideas and at least try and understand why this thing just needs to go. It pains me. It pains me that we are still in this world where in 2023 we're still debating this silly model. But here we are. I want to just kind of give you some perspective and some views, go through just a really simple framework for how we can essentially debunk the concept, but really go at it from a fundamentals perspective, right? We can all point fingers and look at the model and be like, oh, look, it deviated, and we will do that. But what I really want to do is just show why orders of magnitude matter and why it makes absolutely no sense whatsoever to pay attention to this model. So it is a very painful re-emergence of the stock-to-flow model. It does make me question our collective sanity. But what we're going to cover today is why the stock-to-flow model is bollocks. We're going to understand a little bit about the dynamics of supply and demand and introduce a different way of thinking about this, right? Because stock-to-flow as a concept makes sense. The problem is when you do a log-log regression and you start building stuff that it's just not a practical thing to do a price model off. That doesn't mean that the stock and the flow components aren't very relevant, and we will explore this. And they're just some of the tools to try and just model and really demonstrate this, reality versus fiction. So just to give you a bit of a snapshot on the very high level on why the stock-to-flow model specifically is just an absolute basket case. And look, there's been some extraordinarily qualified statisticians and analysts well beyond myself, who have done an extraordinary amount of work to prove that this thing, first of all, that it did work. And then what they found, the more they looked at it, is that it just doesn't. It fails a lot of statistical checks and the like. Now, this model I would put into the camp, I'm going to butcher the actual saying, but it's something where to create a claim of truth is trivial, right? Anybody can say, oh, this is true, this is a model, this is real, this is whatever. To refute that claim requires orders of magnitude more effort, because you can convince people of something like stock-to-flow is going to predict the price in the future. And the problem is that it takes so much effort to actually refute this. So it's this like disparity of work required to kind of push back on this thing. But at some very high levels, I mean, Charles Edwards did this particular bar chart some time back, showing all the different iterations of the stock-to-flow model and what the predicted price was in April 2021. Now, this one here is 50,000. This one here is above 350,000. Here we've got a couple floating around 200,000. I mean, this is this kind of thing here. The error bands that we're talking about here are measured in orders of magnitude. Oh, it'll be somewhere between 50,000 and 500,000. Great. I could throw a dart and literally find a better, like I could literally be closer by just throwing a dart here, right? You could literally ask someone who has no idea what Bitcoin is and just ask them, hey, what price is it? And, they could guess a number that's closer to where we currently are, right? So there's a whole bunch of problems here. One of them is this concept called autocorrelation, which in statistics means that you're basically saying on one axis, right, you've got your stock-to-flow ratio. Well, the stock-to-flow ratio is a function of issuance, right, and supply. And we know that Bitcoin has a predetermined supply curve. So technically, supply and issuance is just a function of time, right? The longer the block time goes ahead, which is also a function of normal human time, the more time that goes ahead, the more issuance approaches that final 21 million cap. So you've got time on the x-axis. And on the y-axis, time and supply. And on the y-axis, you've got the valuation, which is going to be supply times price. So what you're basically measuring here, these two axes are related. Supply is in both of them. You're relating and you're saying, well, when supply goes up, supply goes up. Yeah, you're absolutely right. That's very true. When supply goes up, supply does go up. Well done. So the problem is that what you're measuring is that these two things are literally, of course, they're correlated. And when you actually run the statistical checks, what you find is this mythical R squared number collapses to pretty much zero once you take out the autocorrelation. So you're basically saying that, time is related to time. Well done. Supply is related to supply. Well done, right? So it's statistically meaningless. So it's just not valid from a statistical standpoint. It lacks any input of demand, right? We're literally saying that if the supply goes down because of the halving, price will go up. It's like, well, okay, but what actually drives the price going up? It's demand. If supply is fixed in a predetermined schedule, that is no indication the price is going to go up, because price is a variable and demand is a variable, but there's no demand in this entire equation. It's just not accounted for in this thing. In many of these models, it's a bunch of cherry-picked data points, right? There's the cross-asset version, which tries to cluster things together into, oh, this is the third epoch of Bitcoin. There's other ones where on the original model, it was on monthly data points. Okay, well, which month? Because I ran a study many years ago where I basically showed if you pick the fourth of each month, you get $250,000. If you pick the third of each month, you get $80,000. So your error bars change depending on which monthly data point do you select, right? So which one of these models are we actually looking at, and which data point do you want to use? We talked about the error bands. A huge problem here is it just promotes really lazy and uncritical thinking. It's a really silly approach that just doesn't factor anything really in. And at the crux of it, right, we're assuming that all the dynamics of free markets are predictable based on a single issuance curve. And just thinking about this, like, why aren't Bitcoin forks who have the exact same issuance curve having the same price performance? And the answer is because maybe the issuance curve isn't really the driving factor. That alone, the fact that there are forks who do not follow the same curve, that do follow the same supply curve, but do not have the same price performance, tells you that, well, maybe the issuance curve isn't in fact the thing that's driving the price, right? So like there's just so many cognitive dissonances. And the problem with the stock to flow model is that it gives you a price prediction into the future. And people love to see, oh, show me how rich I'm going to be in 2032. And that creates really bad incentives. People make economic decisions. And I know everyone's responsible for their own decisions, but come on, we're smarter than this, right? We are so much smarter than this. To see all the brilliance of Bitcoin kind of get overshadowed by the stupidity of this model is just a disparity that it's really disappointing. And anyway, look, that's kind of the intro rant. Let's actually get stuck into some data and analyze this thing. All right, so, oh, whoa, hang on a second. This isn't the stock to flow model. No, you're absolutely right. This is the difficulty regression model. This is a model which uses the exact same principles as what Plan B did with stock to flow. This particular model here is a log-log regression. The reason we use log is because both difficulty and when we're looking at price, you kind of have to look at them in a log scale, right? That's the kind of magnitude that they move around in. And what we're doing here is we're saying, well, is there actually a relationship between price and difficulty? And the obvious answer to that question is, well, probably yes, because as price goes up, the coin price goes up, and therefore miners will be more incentivized to mine for it. So difficulty is going to go up. But you also have to remember that this is in fact accounting for demand. This is a kind of, there's a bit of a disparity here between the stock to flow model, which is the issuance creates the concept is that the issuance rate creates the price. Here, what we actually have is a true correlation because the price going up does in fact create demand for the difficulty. There's actually a relationship between these two because one does in fact drive the other, because difficulty will not just stay flat, right? The fact that price has gone up means that there will be a relation to difficulty. As difficulty goes up, miners have to sell more. There is a true market reality that is driving this thing. Now, the reason why something like the difficulty model, now, what we use this for is trying to find out what is the average price to mine, right? Just take all the mining and the hash rates and the geolocation and power bills and ASIC models and all that complexity. It all gets distilled down into difficulty, right? It's kind of like the price to mine. So these two prices, naturally, they're going to be correlated. But what are we using this thing to do? We're not trying to predict the price in year 2032. The reason why something like this doesn't catch on is it's not as memeable. It's far more useful, but it's not as memeable. And this is the big difference as to why this thing gets so much attention, because people love price predictions, right? Price predictions make people excited. They can calculate how rich they're going to be if they buy X amount of coins. It's just so much more memeable. So it's a really important distinction to make here that doing a log-log regression, that's not the problem. The problem is actually the inputs and the economic reality, the assumptions that go into it. And my background is engineering, and something that I often talk about is that when we're designing something in an engineering world, generally speaking, about 90% of the influence comes from about 10% of the factors. And the number one reason why engineering designs fail is usually because people spend so much time designing 90% of their effort on the 10% of things that don't move the needle, right? And they focus all that energy on the wrong thing. And in this instance, yes, issuance creates more coins coming into circulation, no question. And yes, miners sell those coins. There's no question they sell almost 100% of them. This is just fact. And yes, that's obviously going to be a factor, but it's not of the same magnitude as the other factors. So let's explore that. But I just want to start here just to show that we can use a log-log regression. The methodology is not the problem. It's the inputs and the way that it's actually been, the model has been developed. This thing here is relating the price of difficulty, the price to mine Bitcoin, right? Think about it from the gold perspective. The ability, the cost, the inputs required to extract the gold is going to be a function of the gold price. And likewise, when the gold price is too low to incentivize the mining, then less is going to be produced. Bitcoin's a kind of interesting one because that production is going to obviously adjust because of the difficulty adjustment, right? So you'll always have this 10-minute block time or pretty close to it. But at least there's an economic linkage between these two elements, right? The price going up is the thing that incentivizes new and improved ASICs. There is a correlation there. Now, if we move across and look at this to the stock-to-flow model. Now, the argument that I see circulating is that, well, okay, let's apply that same logic. If the halving is coming and people get excited for the halving, well, that excitement for the halving and the reduction in issuance is what actually creates the momentum for people to buy things. Okay, but that's not the real driving factor because otherwise the bear market wouldn't start 2 years before, sorry, the bull market wouldn't start when the bottom gets put in, which is 2 years before the halving, right? My core argument is that yes, there is no question. I'm not going to dispute that the halving is part of the narrative, but the halving narrative follows the price, right? This is this kind of thing. Hash rate follows the price. Miners, their hash rate, the difficulty, the incentive to build more ASICs comes as a result of price performance. So what drives price performance? Well, it's the demand side. It's the demand meeting the supply. Now, that's where we start to talk about, stock to flow. You've got the inflowing. But what we're missing here, this stock to flow model is basically saying that the coins that are coming in via mining, right, 900 coins per day, compare that to the 19.4 million coins that already exist, the stock and the flow, or the inverse of the inflation rate. Let's compare these two and say, well, that's what's going to drive. People are going to say, oh, look, there's less coins coming into circulation. Okay, but what about all those coins that are already in circulation? And this is the part that people miss because what we're really talking about is the amount of available supply, right? This is kind of this different dynamic. We've got 19.4, but we know that 1 point something are lost because of Satoshi, and then there's early miners. And what is the real available supply, right? This is the challenge here. Now, this is the ratio between price and the stock to flow estimate. I don't know about you, but this is the deflection, right? This thing here has just been decaying. It's less than 20% of where it's supposed to be, 27% of where it's supposed to be. This just looks like something that isn't really working, right? And the claim comes in, oh, it didn't factor in paper Bitcoin and futures markets and FTX. Yeah. No joke. Of course it didn't, because how could it? It doesn't factor in anything to do with true market dynamics. It's literally saying that supply go up, number go up. And it's a really, really silly, lazy way to look at things. It just doesn't make intellectual sense. Okay, so now let's start talking about the true balance of supply and demand. I want to just start with a really, really simple model. Essentially, the message that I want to convey and why this stock to flow model is just doesn't make sense is because it doesn't have any form of demand in there. Now, this is essentially looking at the supply. I'm just going to turn off one of these things. This is looking at our circulating supply in orange. And I have two additional traces here. In the pink, I have all of the coins that are older than 1 year, right? Have not moved in 1 year. And the blue is then our long-term holder supply, coins that haven't moved in roughly 5 months. So obviously the gap between, right, the actual pink zone that you can see is the coins that are between 5 months and 1 year. Now, why is this important? Well, for any of you who've been watching my content for some time, you'll know that I often refer to these types of tools. I'm just going to turn this guy on. So get rid of my tooltip. When I look at these particular supply curves, you will see that the stock to flow model at the end of the day is making a relationship between the orange curve, right, the circulating supply or the change in circulating supply, and the price, right? Because if we've got a 21 million supply cap, issuance is just a derivative of that change in circulating supply asymptotically towards 21 million. Now, yes, okay, you can see that price and supply kind of have the same shape. Well, one of them is in linear space, one of them is in log space, so we do a log. Okay. But then I also just look at the supply that's older than 1 year and older than a long-term holder supply. And what do I see? Well, price goes on a spike here in 2013. And look, we had a dip in both of these. And then we had 2017, right? Price rises and we see a dip in overall supply. These things seem to be operating inversely to each other. How strange. We go through the bear market and we see the opposite. We start to see these older coins climbing and climbing until the next bull. And look, they go down. What is this actually telling us? This is telling us that there is a cyclicality to human beings and our behavior. So whilst the argument is that, okay, the halving creates demand, okay, well, the concept of the halving might create demand, but when did that demand kick in? Well, it kicked in about 2 years before the halving during the bear market. The hodlers are the ones who set the floor. Oh, but the hodlers understand the halving. Yes, but the hodlers have to actually do something by pulling out their wallet and sending dollars to an exchange and then buying it. It's okay to believe these things, but the human behavior pattern, the actual reality on the ground, right? Yes, they may be looking at the halving. I mean, I look at myself as a hodler. Sure, I know that the halving's there. Do I really care? No. There's 21 million coins. I've already outlaid that thing to the end of the line. I just understand that the rules aren't going to change, right? To me, that's kind of the economic thing here. I actually make decisions based on the macro scale. I understand what Bitcoin does, but I look at the rest of the world and my actions get distilled in that. So my choice of when to actually start acquiring those coins, right? The problem with the stock to flow model is that it assumes that there's this big, very, very centrally planned machine where there's just this static amount of coins that get sucked out of supply and then the halving happens and then that same amount keeps coming out. It's just not like that, right? There's this human factor, the demand factor. When does the demand actually kick in? And this is what makes things, from a model to something that's actually a useful model, right? The stock to flow model is modeling the 10% that does none of the work, right? It's putting all of this effort and time, well, there's not really much effort, but it's putting all this emphasis in the thing that just doesn't move the needle. So what we see is that we do get this kind of inverse correlation between old supply and price because the smart money sell into the bull and they buy in the bear, right? That makes sense. That's the human behavior that has an economic reasoning behind it. So now what I'm going to do is take those concepts and turn them into annual rates, right? Rates of change. So this here is the Bitcoin inflation rate or the issuance rate, right? Starts obviously very high when there's very few coins, right? And there's 50 BTC, goes down to 25. As the stock increases, the flow gets smaller proportionally. This is the whole argument. Now, I'm going to whack on there the annualized rate of change of long-term holder supply. So inverted. So basically what we're looking at here is that long-term holders spending their coins. Let me just go back one level. Long-term holders spending their coins. So the dip in these colored is increasing. The orange zone here is, let's call it the available supply, the hot supply, the young supply, coins that are actually available for sale. At some point in time, those hodlers sell so many coins that the market simply overwhelms demand and we get a bear market. Likewise, at some point in time, they acquire and squeeze enough coins that we create the bull market. This is the mechanics of actual supply and demand playing out. So let's convey that into an actual magnitude here. So these here is when long-term holders are adding sell side pressure. We've always got this baseline because miners sell pretty much everything. So the orange is a consistent 4% over here after the halving, 2%. We're down at 1.7% now. The long-term holders are adding additional sell side pressure. Now, again, let me just turn off this annual rate, right? If I turn this back on, you can see that we're talking about magnitudes, right? 80%. That means that they're adding it. It's as if Bitcoin had an 80% inflation rate on top of the 1.9% in terms of issuance, right? At the bull market peak. These are coins coming back into circulation. We are talking about something that is 40 times larger than the issuance rate. During the deepest parts of the bear market, right, when long-term holder accumulation is at its peak, we're talking about 84% deflation, right? In the scale of 84% deflation, this is coins getting sucked out of supply going into cold storage. Who cares about a 4.5% in issuance rate? It's just irrelevant. So the problem with the stock to flow model is that it has no semblance of reality in terms of scale. We're talking about the 10%. It's not even the 10%. It's like the 5%. We're talking about the 5% factor. It's there, but it ain't the thing that's driving the market. Now let's just go to just another really, really simple level because I want to keep this fairly, I don't want to overcomplicate things here. We have a double peak in long-term holders spending their coins. You know what else we had a double peak in? Price. Kind of funny that. We had a massive period of deflation where these guys actually went through a period of accumulation following the first peak. And look, price ricocheted higher. Which one of these curves looks like the price chart? It ain't the orange one. You know what I mean? Like the mechanics of what's going on here, we are talking about orders of magnitude, 10, 20 times, 40 times, 50 times more importance should be being put on the actual behavior of the existing stock. Because these coins, during a bear market, they get sucked out of circulation, put into cold storage, and the market essentially discounts them, right? It stops thinking about them because they haven't really been circulating. And the market doesn't know this, but markets are kind of these big brain that just works it out based on the supply and demand dynamics. So these periods where coins come out of circulation are actually a net deflationary force. The market discounts them, but then in a bull market, they come ripping back into circulation. They overwhelm demand. So what we're basically seeing is that the market who previously discounted these coins now has to deal with them once again. And the orders of magnitude here are significant. So even if we let's just look at our last market cycle, right? Just to get a bit of a sense of scale. So over recent weeks, right? This kind of choppy noise that we're talking about. The current issuance rate, 1.7, 1.8, that's kind of the magnitude we're talking about percent. The long-term holder rate, just on any particular dip, right? Even back here where it's really small, we're talking about 4.2%. That's twice as large. Right before Luna started, we're talking about 17%, right? Versus 2%. We're talking about, what is that, like, I don't know, 10 times, thereabouts, something in that kind of magnitude. 13% or negative 13, negative 15%, right? Even on these tiny little bumps here, we're talking about 1.8% in issuance and 6.3% in terms of long-term sell pressure. So even in like the microcosms, we are still talking about long-term holders applying 3 times more of an impact. This is all about a sense of scale, right? The issuance is just irrelevant by comparison. And that none of this even factors in the short-term supply, the futures markets, the options markets, the hundreds of other market dynamics that just quite frankly don't care about how many coins miners are issuing, right? It's just irrelevant in the sense of scale. Now, this is the last one I want to close on. I kind of wrapped all of that concept into what I'm going to call a net inflation rate or a market inflation rate. Let's think about issuance as sell side, right? So that 2% coming from miners, that's just baseline sell side. If you've got long-term holders acquiring coins at 2% and you've got issuance at 2%, I'm going to consider that to be zero, right? They cancel each other out. So what I'm looking at here is how much are long-term holders adding to or offsetting the amount of issuance. So zero, right? A net inflation rate of zero means that long-term holders are perfectly acquiring and holding on to all the coins coming out from miners, right? It's perfectly net neutral. A positive value, these large spikes, means that long-term holders are actually adding sell pressure well over and above the issuance rate, right? It's like having more miners active. Likewise, in a bear market, at the bottom of bear markets, we've got negative 14%. That means that long-term holders are acquiring coins at a rate of, they're consuming all of the issuance, and they're still then taking 14% of the supply off the market at that point in time. And if we just stand back and look at this now, I'm going to turn off the issuance rate. One of these models just seems to have a very, I don't even need to run the calculations, right? You can, but you can see that we have a relationship with price, right? Down is down, up is up, down is down, up is up. Kind of funny that way, isn't it? So when we actually then overlay the inflation rate, right, not only are we talking about a system of magnitudes, but this simple concept of just looking at the actual demand of the stock. This is the thing the stock to flow model gets just very, very wrong. The stock is static. It's fixed. So is the flow. These things are predetermined. They do not respond to the market. There's no response factor to demand. Whilst this is not a perfect model, in fact, this is it's not even a great model. It's just a really simple way to visualize this thing. The actual movement of the stock, long-term holders buying and holding, selling and distributing, right? That is true, a sense of scale of market demand. It is orders of magnitude larger in terms of its day-to-day impact. It's significantly more related to the actual price. I mean, you can literally see here's 2019, right? It's got this kind of double pump. There's all this stuff going on. You can see the double pump in 2013. This is a true representation of the mechanics of the market. Now, there's the whole quote, all models are useless. What was it? All models are wrong, some are useless. Yeah, but some are also just complete bunk, right? As an engineer, I can design a model for anything. That doesn't mean it's actually relevant or actually models the thing you think you're modeling, right? The problem is that we're getting the kind of stock to flow crowd is getting stuck on something that actually has such insignificant relevance to the market price. And the thing that frustrates me is that like this took me, this particular model we're looking at was developed some time back. But these charts before, it took me 15 minutes to kind of work out, right? This is not hard stuff. This is not rocket science. We have models that are just orders of magnitude. It's not even orders. I mean, it's many orders of magnitude better at describing the true phenomena, right? This stuff is, it's kind of, it's not even academic. It's really, really basic. And I'm just so surprised that we're still confused about this as a market, as an industry, as a conversation. But anyway, that's enough for me rambling and ranting about it for sure. Hopefully that kind of makes a bit more sense. It kind of contextualizes what's going on. Certainly hope it contextualizes why I find it so frustrating that these very, very simple concepts are just massively misunderstood by so many people. And the problem is that it leads to people making poor economic decisions. And yes, I'm all for people having their own kind of personal views and taking responsibility for their choices. But at the same time, we shouldn't, as an industry, be elevating and lifting up something that is just complete bunk and bogus like this, especially when we have vastly superior tools at our disposal. So hopefully this kind of outlays those dynamics. We have the tools to model the supply and demand balance far superior. And at the end of the day, what do we want to try and do? We want to find accurate information. And what we're kind of seeing here is that stock to flow is not going to give us anything even remotely close to useful information because it doesn't account for the most important part, which is the dynamic part of the market, which is demand. We know the supply, right? But that doesn't mean we know the price in the future. If we did, right, the whole efficient market hypothesis just, well, why don't we all why doesn't the price chart look exactly the same as the issuance curve? Why don't forks follow the same kind of price performance? There's all these kind of just really simple, take it to the extremes and it informs the mean type questions that it just breaks down. So anyway, hopefully that's useful. Do let me know if you have any comments or thoughts. It's always a fun topic to go over this stuff. I'm surprised we're doing it again, but here we are. Let me know if that makes sense. If there's anything else I can kind of break down for you, do let me know, and I will see you in the next one. Cheers.